Cracks in the financial system are getting wider and the whole world is watching. China is no longer staying quiet in the background. It is making careful moves that directly challenge America's financial power. For decades, Washington believed the dollar would always stay at the center of global trade and security. This belief shaped world politics, wars, and the global economy. But now that confidence is disappearing. China is slowly cutting down its investments in U.S. Treasuries, the bonds that keep America's government funded. At the same time, it is buying more and more gold and building partnerships with countries that want to escape America's influence. These are not just plans on paper. These are real steps already changing how global finance works. Inside U.S. government offices, leaders are scrambling for solutions. On Wall Street, investors are quietly moving their money. And in homes across the world, ordinary people don't even realize that these changes are already touching their savings, their jobs, and the cost of everyday goods. Every action taken in Beijing echoes in global stock markets, company boardrooms, and family budgets. This is not just another trade argument. This is a battle for financial power. And for now, China is gaining the upper hand. The numbers prove it. In July, China's holdings of U.S. Treasuries dropped to around $730 billion, down $26 billion in just 1 month. That is the lowest level since 2009. Back in 2013, China held almost $1.3 trillion in U.S. debt. In just a decade, its share has been cut almost in half. Selling such huge amounts is not a casual choice. It is part of a careful long-term strategy. To understand why this matters, you need to know what treasuries are. They are U.S. government bonds, essentially IOUs that America issues to borrow money. They are the backbone of the U.S. financial system. Treasuries fund government programs, the military, and everyday spending. They also support the dollar's reputation as the safest and most reliable currency in the world. But this system only works if foreign countries keep buying. When they step away, confidence in the dollar begins to crack. Meanwhile, America's debt is exploding. It has already passed $37 trillion and grows every single day. To pay for this, the U.S. depends on foreign buyers. But China is pulling out. Japan is also reducing its holdings. And in the Middle East, more countries are starting to trade oil in China's yuan instead of dollars. All of these moves put pressure on the U.S. bond market. If fewer foreigners buy treasuries, the U.S. will have to borrow from itself, through its own banks or the Federal Reserve. That means higher interest rates, more inflation, and weaker trust in the dollar. Mortgage payments, car loans, retirement funds, and even the price of food could all be affected. The question is simple. If fewer countries are willing to lend money to Washington, who will replace them? And if no one can, how long can America keep borrowing at this pace before the system begins to break? China's reasoning becomes clear when you look closer. Its decision to pull back is not about making quick money. It is about long-term safety. Chinese leaders have said for years that the dollar is not just a currency, it is also a weapon. That warning became reality in 2022, when the U.S. froze Russia's foreign reserves after the war in Ukraine began. Hundreds of billions of dollars that Moscow thought were safe became useless overnight. For Washington, it was punishment. For Beijing, it was a warning shot. China imagined a future conflict over Taiwan. If the U.S. froze nearly $1 trillion of China's assets, the damage would be catastrophic. The risk was too high, so Beijing started moving away from U.S. treasuries and into assets that America cannot control. Gold is at the center of this strategy. Unlike dollar-based assets, gold cannot be blocked by sanctions or seized by banks. It is real, physical, and recognized everywhere in the world. By growing its gold reserves, China is building protection against U.S. financial pressure. At the same time, it is spreading money into other major currencies like the euro, the British pound, and the Swiss franc. These are not as safe as gold, but they are less dependent on U.S. policy. And China is not acting alone. It is encouraging other nations to break away from the dollar too. Trade agreements are being signed in yuan. Oil deals are being settled outside the dollar system. New payment networks are being created to avoid relying on American banks. Piece by piece, the global system that kept the dollar on top is being challenged. The United States still has many advantages. Its financial markets are deep and powerful. Its military strength remains unmatched. Its institutions still have global trust. But history shows that no empire stays on top forever. Britain once thought the pound would rule the world forever. It didn't. Before that, Spain believed its empire would never collapse. It did. And today, America faces a similar test. With debt rising and rivals building alternatives, the pillars of U.S. financial power are weaker than they seem. Every treasury bond that China sells, every bar of gold it buys, every deal it makes in yuan is one more step in this shift. The dollar is still the world's leading currency, but for the first time in decades, its future is no longer guaranteed. And as this struggle plays out, it will shape the lives of billions, deciding who holds the real power in the global economy for the years to come. For the United States, this turning point comes at its moment of greatest weakness. With national debt surging past $37 trillion, the system depends on foreign demand to keep borrowing costs under control. If major holders pull back, Washington must lean on domestic banks and the Federal Reserve, leading to higher interest rates, more money printing, and rising costs for every household. The strain is already visible. Treasury auctions demand higher yields to lure buyers. Inflation refuses to fall to levels the Fed can tolerate. At the same time, the BRICS bloc is quietly building trade systems that bypass the dollar altogether. Step by step, the financial order is shifting toward a future where U.S. Treasuries and the dollar no longer hold their uncontested crown. Wall Street may be hitting new records, but beneath the surface, the real economy is cracking. Job growth has stalled, with only 22,000 positions added in August, unemployment rising to its highest since 2021, and earlier data revised downward, revealing losses where gains were once reported. Manufacturing, construction, and professional services are already cutting back, flashing clear warnings of a slowdown. If this continues, consumer spending will shrink, and with it, the backbone of the American economy. Even the most powerful voices are sounding alarms. BlackRock's Larry Fink warns the economy is weakening before our eyes, while J.P. Morgan's Jamie Dimon puts the odds of a recession at 50-50, pointing to fragile credit markets weighed down by excessive debt. The data backs them up. The economy shrank by 0.3% in the first quarter of 2025, the first decline since 2022, and forecasts show growth slowing to less than 2% in the years ahead. Yet markets appear unstoppable. The S&P 500 shattered 25 records in just 3 months, riding double-digit returns. But this rally rests on fragile hope, investors betting that weak data will force the Fed to cut rates. If inflation stays high, layoffs spread, or profits fall, that hope will vanish overnight. The cracks are already there, and Beijing sees them clearly. China is not letting reserves sit idle. It is moving them into Europe, where the euro offers scale, stability, and the advantage of being tied to China's largest trading partner, with nearly $860 billion in trade. Britain remains a gateway to European markets, with the London Stock Exchange expanding access for Chinese firms. The pound plays a smaller role but adds diversification and another link to the West. Switzerland, despite its size, offers what others cannot: neutrality, stability, and the trusted safety of the franc, a currency that continues to attract capital even in downturns. For China, euros, pounds, and francs are not just assets, they are protection against shocks and symbols of a new balance. By diversifying away from treasuries, Beijing sends a message: the dollar is no longer the only option. And perception is power. Once other nations believe the dollar can be replaced, the old order begins to crumble. Auction by auction, faith in treasuries is slipping, and with it, the dollar's dominance. History shows power never waits for rivals to catch up. If the pillars of American finance are shaking, the world is already preparing for what comes next. The question is not if, but when. And when it arrives, the global reserve system may look nothing like the past, and it may not be America that controls it.